Hi, this is Osama Rizvi from Primary Vision Network, and welcome to another episode of Monday Macro View. As we step into the new year 2023, I thought it would be interesting to look at some of the outlooks moving forward. For instance, the most important outlook I believe is that of the oil markets. So in this episode, I would want to talk about very briefly, how will and what will be the behavior of the oil markets moving forward. Also, some of the recessionary indicators, what are banks saying, what are other people saying about recession, and some of the risk factors, and finally a recap of 2022. But we'll be dividing into two parts. Two of the factors I'll be discussing today and two afterwards. So let's jump in. Let's start with the oil markets. So oil markets have been in a continuous to and fro motion, seesawing between two camps, as I've already explained in many of my articles as well, in previous episodes as well, that there is demand destruction, then there is oil supply concerns. But we need to look at some of the data points and see what they actually say about it. So OPEC's recent demand outlook came out, and they have kept the demand estimates for 2023 the same as previous years. So it would grow by 2.2 million barrels per day, amounting to 101.8 million barrels, which is as expected. There's no change in that. But there was another interesting aspect to it, that in November, almost 43 to 44,000 barrels per day of oil supply was added, amounting the total to 101.5 million barrels per day, and that is 3.2 million barrels per day higher than the previous year. So when talking about supply concerns, we are seeing that not only the Chinese demand has slowed down, we will talk about it as we move forward, but the supply side has also been, if not resilient, but stable. So in the longer run, we might see a supply concern, supply crisis, a supply crunch, but in the shorter run, let's say for the next 2 or 3 quarters, I do not see that happening at all. Talking about some of the factors, so while I remain bearish on oil markets, there are some factors that, if there are variables within them interplay or interact in a certain manner, that may result into another oil price rally. So some of the factors you can see on your screen. So the G7 oil price cap, so far it has been all of this price cap episode has been without drama. People or countries and shipping industry and companies seem to be compliant to that. Recently, India, 5 million barrels of 7 tankers, according to Kepler and according to an analysis by Financial Times, Russia sent 5 million barrels of oil to India under the price cap. All of those tankers were insured by Western companies. So we see that even Russia is sort of trying to not draw further ire of European countries in the form of sanctions. But if things go otherwise, we might see another oil price rally. Falling spare capacity of the OPEC, we'll talk about it. It remains one of at the lowest points, and that can be a concern that can fuel a bullish sentiment moving forward. Other factor is U.S. oil production, shale oil production. So far, the estimates remain resilient, but if they do not meet the criteria, we might see that there might be some addition of bullish factors in the market. And finally, geopolitical tensions, Taiwan issue, Iranian aggression, if there is a missile strike, these flashpoints are always there, and you can never be sure of them. So Russian oil production, one of the factors that you add up to them is Russian oil production. Russian oil production was expected to fall up to 3 million barrels per day, but so far, according to EIA, but so far it has only fallen 0.3 million barrels per day. That's a drastic sort of difference and discrepancy. And China, Turkey, India, they have replaced Russian markets. Russia has been exporting to them, and I think the trend will continue, and the Russian oil production will remain resilient. But one question is that how long will the oil fields will be productive? So that's because as companies have moved out, who is going to take care of the oil fields there? That's another question. We might answer that in the coming episodes. Spare capacity, as you can see on your screens right now, remains at 3.5% of the global production, one of the lowest in the histories. That remains a concern. And I was talking about US shale production. So far, the estimates is that of all the global demand, of all the global oil production growth for the 2023, 50% will be coming from the US, and which will be about 1 million barrels per day. Moving forward, China is also a very important player in oil markets. So, according to a recent analysis by John Campt and Reuters, for the first 10 months of 2022, the passengers traffic from all modes of transportation remained low. It was 76% down versus pre-pandemic level of 2019. China's crude processing remained at minus 1.8 million barrels per day, which means that is less than the 5-year moving average. We will see that on a month-to-month basis, on a yearly basis, it might have increased, but on a 5-year moving average, it has decreased. And if everything goes well, if China is able to lift its lockdown and everything it will still take 3 to 6 months, but the maximum demand we're looking at is around 1 million barrels per day. But the thing is, China has been, even if China recovers, it might not result into a strong oil buying. Why? Because China has been buying up a lot of oil. There was another analysis by Clyde Russell and Reuters which showed that China has more oil in its inventories than it was purchasing and than it is exporting. So China's refinery throughput is up from 14.21 to 14.51 million barrels per day. And in the first 11 months of 2022, around 700 barrels per day went into the inventories. So we might not see a resurgence in strong buying by China, even if China opens up. So talking about the recession. So now the question remains that the question isn't that whether there will be a recession, but how steep, how deep it would be, what will be the magnitude of it. So according to different estimates, there is around 10 to 12 months of policy lag between monetary policy and its effects. However, the timeline can depend upon the aggressive stance by the global central banks. So according to the Council of Foreign Relations Global Monetary Policy Tracker, around 54 countries are expected or will remain on their track to raise interest rates altogether. That can usher in a recession before any year, that is by the mid of the year or by the first or second quarter. However, on the spending side, so there are different indicators of a recession, spending still remains strong, but savings are shrinking by $90 billion a month. And in about, according to an interesting article in Forbes, in about 16 months, consumers' bank balances would return to normal. So that might result also in a fall in spending. However, spending has not fallen until yet. So these are two different point of views, and both of the developments, as they will happen, they will result into different timelines in the form of a recession. Furthermore, US industrial production, another factor that is watched by NBER, who officially declares recession, it's also falling. So it is suggested that it is near its peak. So that's a factor that might result in, once again, a recession earlier than it is being expected. However, on the job loss front, the jobs are still going strong, but we know that unemployment is expected to go to 4.5% from 3.7% right now, and there has not been any recession that has resulted until there has been an increase in unemployment. So we will also have to look at this. How long will it take? People are saying next year, so give or take, according to all the different indicators, we are expecting US to be in recession by next year. Finally, I talk about personal income. You can see on this chart, personal income level seems to be quite resilient up until this moment, but they might fall as we move forward. There are different estimates regarding a recession and when will the monetary policy peak all across the world. So UBS Bank expects US inflation to be close to 2% by the end of 2023, which I do not believe in. It's too quick. If that is to eventuate, I believe the interest rates would have to be, there would be more 75 basis point hikes, and I do not think Fed is going to afford that. Furthermore, Wells Fargo thinks that the cycle will shift by the end of 2024. Morgan Stanley sees similar to the UBS by the end of 2023, that the stance would shift, and so that the Deutsche Bank. But all of these estimates are, I believe, on the positive front. They paint a rosy picture. We continue to see sticky inflation. Marcus Arno has spoken about this at the Econ show as well. I do not think, we do not think that there would be a pivot in Fed's policy this soon, this early. So that's all from today. Let's meet next week and talk about the market sentiment tracker along with the tail risks and the recap of 2022. Thank you so much, and looking forward to seeing you next week.